How can student loan interest lead to debt traps? Imagine borrowing money to pay for college, thinking it's just a temporary fix. But over time, that small loan can grow into a much bigger problem. That's where student loan interest comes into play. When you take out a student loan, interest starts accumulating right away. This interest is a percentage of the loan amount, and it adds up each month. If you don't pay enough to cover the interest, the unpaid part gets added to your total loan balance. This process is called capitalization. It means your debt gets bigger even if you're making payments. For students trying to build credit, making regular payments on time is key. But if the interest keeps growing faster than your payments, your debt can spiral out of control. High interest rates, sometimes up to 7% or more, make this worse. If you're not paying enough, the loan balance can increase because of negative amortization. That's when your monthly payments are too low to cover the interest, so the debt grows instead of shrinking. Deferment and forbearance are options that let you pause payments temporarily. But these usually don't stop interest from adding up. During these periods, your loan balance can grow even if you're not making payments. If you don't finish your degree or find a job that pays enough, it becomes harder to keep up with the interest and principal. This can lead to falling behind and even defaulting on the loan. Defaulting means the entire loan becomes due immediately, and interest keeps adding up. This cycle can trap students in a mountain of debt that's tough to climb out of. High interest rates are a big part of the problem. Student loans often have rates up to 7% or more, which means interest accumulates quickly. If you're using income-driven repayment plans, your monthly payments might be low, but interest can still grow if the payments don't cover it. Not understanding how interest works can also cause trouble. Some students overestimate their future earnings and borrow more than they can handle. To avoid falling into a debt trap, it's smart to make at least the minimum payment on time. Know your loan's interest rate and how interest accrues. If possible, choose repayment plans that match your income. Be cautious with deferments and forbearance unless absolutely necessary. Budget carefully so your loan payments don't interfere with other financial goals. Managing interest is essential because if it keeps growing, paying off the loan becomes much harder. Remember, understanding how interest works helps you stay in control of your student debt and build a solid credit history.